Hi there, I'm Juston Jirwander from Bishop Collins Chartered Accountants. We have offices on the Central Coast, in Sydney, and also in Tamworth.
What is classified as a high income earner?
Yeah, that's a good question because it depends on one's perspective, but I would say from a tax point of view that anybody who's earning over $250,000 is a high income earner and should consider the way in which they're structuring their finances and how they buy assets. Anybody around, the top marginal rate cuts out at $180,000, starts at $180,000. So that could be considered high income earner over $180,000. However, it also, we also should look at other forms of income and where they get that income from. So if it's salary income, then, maybe $250,000. Maybe they get $180,000 as a salary, but they've got a whole lot of investments, and that pushes them up into much higher brackets. But generally, I'd say over $250 for me personally. That's what I would think.
Why is it important for high income earners to reduce their taxable income?
Well, we never like paying too much tax, but we, as a society, have to pay tax, and I don't think it's anything we would not want to do. So the real key is not paying too much tax, which is why high income earners, although they do get a bit of a beating around about, how do they always get around paying less tax? They actually pay a lot of tax, but they don't need to pay more than they should. And that's where we really focus on that side of it, which I think is quite highly ethical, really. And, whoever wants to pay more tax or too much tax.
What are the top 3 strategies for high income earners to reduce taxes in Australia?
Top 3 strategies for me is 1, structure. So important. 2, timing. And 3 is just knowledge of what is deductible, what's assessable. So structure means to me, taking it off the location of buying a property, is getting your asset in the right structure, getting your business in the right structure, operating in the right structure. Now, the structures are individual, partnership, trust, company, or a self-managed super fund. Anyway, that's structure, getting it in the right structure. Timing is whenever you buy, sell an asset, or distribute income, always get it into the right time. So that could be in a right year, or it could be you hold out for a little bit longer to achieve a benefit because you've held on to, say, a business asset for longer. For example, if you're earning in 1 year a high amount and the next year you know that your taxable income will be lower, maybe you're changing jobs, you're going to have a big break, and you have other income coming in, or you have an asset that you want to sell, you would then time your receipt of that income in the period where you're going to get lower income. So, give me an example. This year, I'm earning $250,000. Next year, I'm only going to earn $100,000 out of a salary. I have investments, and those investments go through a trust, and I usually get that income to go to my partner. However, my partner next year will be earning more money than me. So next year, I know that I'm going to be putting that to my income, as well as I have some assets I want to sell. So if I want to sell those assets and realise a gain and then have to pay the tax on it, that income from a trust has to get distributed to somebody. Income in a trust has to be distributed. So I would then time it to come to me. So that's a very important part. There's also, timing is critical in terms of when you might sell a business, not just a property or an asset, but a business. If you've been operating that business for 14 years and you sell that business for $1 million and it didn't cost you anything, you've made $1 million gain, and there are certain concessions you can get. However, if you waited 1 more year and it was 15 years, then you would pay no tax, potentially. So it's significant. It can be really significant when you consider timing of when you do something, when you buy, when you sell, and when you choose to distribute. And the third thing, knowledge, is really a critical part of knowing all the complexities of the elements that are deductible, of what you can and can't do. There's too many to list, but it's really important that you speak to an accountant around that. And if you need to, if you don't have an accountant, speak to us.
What do you mean by tax structure?
You actually bring a good point about structure, because people don't really quite understand what do you mean by what does structure mean. Well, structure means where, let's think of it this way. Structure is where does the income come into? Do you want the income to come into your own name? Do you want the income to come through a trust, which then gets distributed by the trustee, who's like the boss of the trust, who determines where it goes for the benefit of the beneficiaries, so they're the people who benefit from it? Or is it a company?
What would be the right tax structure for me?
Wow, okay. How long have we got? So the reason why I say that is because it depends on everybody's personal situation. And no person's situation is the same as anybody else. It depends on number of children, their age of the children, age of the taxpayer, how long they have until retirement, how much they have in super, how much income they get from other sources, whether they wish to distribute income between other family members. So, trusts have that ability to distribute. Self-managed super funds, they're a low-taxed environment built up so that you can save for your retirement and not have to rely on the government. Partnerships and companies tend to be for more operational issues. There are some benefits in putting it into a company. There are some benefits in a partnership, although in my opinion fairly limited. There's so many different things and reasons why you would choose any of those entities. So if you put revenue into a company, there's different reasons why you would want to do that. There's different reasons why you'd want to put income into a self-managed super fund, which you can. You can determine to have your own super fund or a retail super fund.
Could you explain a company setup, for example?
Yeah, so when you're talking about a company, remember with structures and a company and trusts and partnerships, etc., they are all separate legal identities. So having a company is very good for risk management, and it also has a lower tax structure. So the tax rate for a company can vary between 25% or 30%. 25% for a base rate entity, so that's a company that's basically operating a business or doing something, not investing. If it's an investment company, then it's 30% tax. Or if it's a large company, then it's 30% tax. So that the benefit of having a company is there's really risk management because it's a separate legal identity, which means that the directors run the company for the benefit of the shareholders and other stakeholders. And if something were to go wrong with the company or there was a legal challenge to the company, it's separate to the individual shareholders and it's separate to the directors, although the directors can be liable if they've acted inappropriately or their duty of care hasn't been satisfied or they've traded while insolvent. So there's a lot of things to consider there if you're a director and to do it properly.
What are the benefits of a discretionary trust?
Yeah, so a discretionary trust is a little bit of a tricky one. There are some recent rules that have come out regarding, Section 100A, but I won't go into all of the details. But a trust is set up for the purposes of the beneficiary. And usually a common type of trust is a family trust, which is a discretionary trust, which means that any of the income is distributed to the beneficiaries by the trustee at the discretion of the trustee. So they determine, remember I said they're like the boss. Trustee is the boss of the trust. And they determine where that money will go at the discretion of their discretion each year. You can have different trusts like unit trusts, which operate more like a company, but let's not talk about that right now. Discretionary trusts or family trusts, they're set up to basically, so when income comes into the family trust, they can distribute it to whoever the beneficiaries are, usually partner A, partner one, partner two, or mum and dad, or dad and dad, or mum and mum, let's not be, yeah. So, or their children, or any related parties to them. So they can distribute it to all of these different people. However, if they distribute it to those people, they must be sure to actually distribute it. Okay, so that's the tricky part. The benefit of a trust is that the trust allows you to utilize different beneficiaries' marginal tax rates. So let's say if mum has a tax rate that's too high because she's earning too much, dad has a lower tax rate, he's earning maybe 50,000, then the trust income could go to the dad and then you're paying at a lower tax rate. Or let's say there's children, adult children, not children, anybody under 18 is not allowed to take, let's just say for all intents and purposes, you shouldn't distribute to them. Then when they're over 18, those children can get some income distributed by the trust. So they're out, so let's say they've finished high school and they're going to uni and mum and dad are supporting them. And so the trust actually can support them and pay for their costs. And so any income you can distribute to those children. That's great because they get 18,000. Actually ends up being a little bit more because of different tax offsets and concessions, however, depending on the year. Let's not go into detail, but there's a certain amount, the tax-free threshold that they can claim can be distributed income and no tax, rather than going to mum or dad at 47%. So that's why there's so many complexities that you really need to have a good chat to your chartered accountant about it.